Mid-sized companies increasingly mentioning tariffs on earnings calls. Members of the Russell 3000 mentioned tariffs on earnings calls over 5,000 times in the month of May. And as we head towards the final 30 days of the 90-day reciprocal tariff pause, what does this mean for small and mid-cap investors? I want to bring in Mike Casper, Bloomberg Intelligence sector and small-cap equity strategist. Great to have you here, Mike. Talk to me about what it's going to take for small caps to outperform again, especially given not only the tariff uncertainty, but the macro uncertainty that's causing as well.
Yeah, well, there's two things I'm really watching. One is the Fed, and one is our fundamentals for companies, right? So fundamental growth for Russell 2000 companies has to be stronger than the S&P 500 just to start for small caps to outperform. We haven't really seen that since 2018, 2019, and the 2021 recovery period after the 2020 recession. So we really need to see fundamental growth pick up. Now, we started to see some of that in the first quarter, but a lot of the revenue growth that we saw in the Russell 2000 might have been pulled forward from this tariff hit, right? So if you think about how companies are going to brace for tariffs, they're going to buy products in advance of the tariffs hitting, trying to get ahead of some of those tax consequences and build up inventories. So the question is, going into the second quarter earnings, was that a buildup or was that actually organic growth? And we'll see more as we get more results.
Yeah, and Mike, I hear you talking about something that we talk about so often with our sources, that it's just really hard to tell with regards to tariff policy that is constantly changing, and also whether it's a pull forward dynamic or indicative of something else. Given the uncertainty that tariffs create for small and mid-cap companies, should investors be looking at specific stocks more so than the broader index in this environment? And if so, what's the best way to do that?
Yeah, so if you're talking about specific stocks and sectors, I tend to focus a little bit more on sectors. Across the board, both in mid caps and small caps, and even in large caps, tech is the most foreign exposed sector across all of these three indices, the S&P 500 and the Russell Mid and the Russell Small, right? So tech is one that can be very badly hit, right? Now, we've had some reprieve on the tariff front for tech specifically. You know, Trump's gone back and forth whether there's going to be tariffs on semis, and he's pulled it back, and he said it's going to come at a later date. So there's a lot of uncertainty around that. But if there are specific tariffs on tech products, it would be pretty disastrous for the sector. Now, in terms of small and mid-cap companies specifically, they do have less foreign exposure significantly than large caps, right? So when we're talking about cost of good exposure, for mid-cap companies, we're talking about 40% of the index has cost of goods exposure outside the U.S. That's in contrast to nearly 50% for the S&P 500, and it gets even smaller as you go to the Russell 2000. And when we're talking about revenues, so reciprocal tariffs, tariffs China might put on the U.S. and so on and so forth, small and mid-cap companies are only about 20% revenue exposed to foreign entities, whereas the S&P 500 is about a third exposed. So there is significantly less exposure down cap. Whether that translates to fundamentals is yet to be seen.
What about on the reconciliation front perspective? Is that going to benefit your space? And especially since R&D expensing and bonus depreciation could be a potential boost to Capex this year, could that benefit your space at all?
Yeah, our R&D exposure definitely could benefit the space. The issue is, with all the tariff uncertainty, do companies pull back on their research and development and their Capex plans, right? So it was something that I was really watching, especially in large cap earnings in the first quarter, were these tech companies that, again, are very exposed to foreign sales and foreign COGS exposure, were they going to pull back on their Capex? And we didn't really see that, right? So, Microsoft kind of reaffirming their plans, and some of the other large cap tech companies reaffirming their plans. I saw that as a very good sign and could benefit small cap companies going forward if they do continue to spend at the pace that they are spending.
I want to end on one of the headlines on your notes that you worked on with Gina Martin Adams, another friend of the show. Stalling economy may be worse for stocks than a failing one. Explain that to me, Mike.
Yeah, so a failing economy, right? You get the washout very quickly, and you get a recovery very quickly. If you think about recessions that were very V-shaped, for lack of a better term, so 1990 was pretty V-shaped. 2020 was probably the textbook example of a V-shaped recession. We had the complete recessionary washout. Within 2 months, you get a very quick recovery, and stocks tend to benefit, and the Fed has very high clarity on what they need to do to reaffirm the outlook for the economy and subsequently for stocks. If you get a stalling economy, it's a very dragged out experience. Think about your 2008, 2009 recession or your 2000 through 2001 recession, where stocks didn't recover for 5 or 6 years off of that recessionary low because policymakers don't have as much clarity on what they need to do, and so on and so forth. So really, if you get a quicker washout, it tends to be better for stocks. There's a quicker chance of recovery.
Mike, really appreciate you making the time and breaking that down for us so well. Thank you so much.
Thank you.